final PPM meeting of the semester. I'm getting emotional. But we're doing a little beginner's guide to investing today. And we're also going to be talking about the future events for PPM next semester. There are a lot of exciting things coming up. Before we get started, I'm just curious, how many of y'all have a brokerage account opened up already? Okay, so a little over half. We're going to be detailing how to open a brokerage account, how to choose a brokerage account, and then some of the actual things involved with trading stocks. So after that. Within this beginner's guide to investing, we've divided into a couple different buckets. The first, why should you invest? So we've talked about this a little throughout the semester. Dr. Dolman gave a little lecture about why you should invest, talking about index funds, but we'll detail a little bit about that. How to open a brokerage account, can anyone invest, how do you choose a specific firm over another, the different order types. So when you actually open your brokerage account and look to buy a stock, there's market orders, limit orders, stop orders, so we'll detail a little bit about what each of those means. Stock positions, Max will talk about what are long positions, what are short positions, what are the different funds we can invest in, index funds, ETFs, mutual funds, what's the strategy. So after we have all of that figured out, what is our strategy? What do we want to do with these investments? Do we invest it all at once in individual equities? Do we buy index funds? What's the strategy going forward? So we'll talk about that.
And a large part of PPM is financial literacy. We've been focused on spreading financial literacy everywhere. And in this meeting, we're also going to talk about a few of the big aspects of financial literacy, and that includes investing, as Sam said, why to invest and how you can invest, retirement, with your accounts such as the Roth IRA or traditional IRA, and other ways to save retirement, and credit, the importance of credit and how you can improve your credit score. Now, we're not going to be talking about credit this meeting for the sake of time, but next semester we will be inviting a Equifax employer to talk about credit in his own seminar then.
So let's talk a little bit about why you should invest. Obviously, you guys are here, you know that you should invest, but let's look at a little bit about some of the factors. When people get into investing, there's always a question about timing. The markets are at an all-time high right now, crypto's at an all-time high, stocks are at an all-time high, everything's at an all-time high. Should I get in the market right now? You probably heard me say this before, time in the market beats timing the market. So the more exposure you have to stocks beats trying to buy it at the lowest price or buying at the highest price. So more exposure is better than trying to get in at a good time. So there's never a bad time to invest. Even if you invest at the worst times, statistics show that people who have more exposure to investing will actually do better. Why wait? It's never too early to start investing. Whether you have $100 in your pocket or you think you're too young as a college student, it's never too early. There's always a concept that we invest because we're going to need this money when we retire at 65, so why are we starting right now? Maybe let's start later. Right now, time is on our side. The power of compounding. The younger we are, the more we invest right now, compounding is on our side for the future. So start early, start right now. And then growing your wealth. A lot of you probably have a checking account or a savings account. As you've probably seen, you're probably getting between 3 or 4% interest in your savings account. Max, if you go to the next slide, had you invested in the S&P 500 1 year ago, you would have made 31% returns. So maybe you got 3 or 4% in your savings account, which is nice, 4% free. You could have made over 30% had you invested that money. This requires no knowledge, just investing in the market, and you obviously get great returns. Historically, market goes up. Obviously, this year has been better than most years in history, but historically, the market always goes up over time.
And another thing to consider when you're investing is retirement. Obviously, everyone's hoping to retire at some point in their lives, not trying to be working forever. And the two main ways to do that are through your Roth and traditional IRA. Now, for both of these accounts, you will need to be 59.5 to withdraw, and if you choose to withdraw early, there will be a 10% penalty on whatever you're taking out. And there's also a $7,000 deposit limit. I know that sounds like a lot right now, but in the grand scheme of things, it's not that much, which is is why it's super important to always try to contribute to whatever account you have. For starters, let's look at the Roth IRA. Now, this is also known as a tax-free account, which means that your contributions to the account are made after you pay your taxes. However, when you withdraw the money from your account, say when you're like 60 years old, all the profits are going to be tax-free. So this is especially beneficial for people that plan on retiring at a higher income bracket than they are now. So basically, if you start at an entry-level job and you work your way up the ladder and you end up having more assets in the future, and you're in a higher income bracket, you have to pay more tax on things, a Roth IRA is more beneficial because all your profits will be tax-free. Now, the opposite, not the opposite, but something similar is a traditional IRA, which is also known as a tax deferred account. Now, these contributions are made pre-tax. So whatever you contribute to this account, you can use as a tax deductible from whatever you're paying currently. However, the one downside of this is that when you withdraw your money from your traditional IRA, all the profits will be taxed at whatever income bracket you're at when you're retiring. So when you're probably around 60 for most people. Now this is better for people who plan on retiring at a low income bracket. So people that are planning to kind of chill out early and try to live a calm, quiet life.
So Max, who would you recommend like the general college student to open? A Roth IRA or a traditional IRA?
Yeah, that's a great question. So for most people, and also specifically college students, a Roth IRA is generally recommended. This is because everyone here is going to college. We're getting higher education, trying to land a high-paying job in the future, and eventually climb our way up. And through the years, we're hoping to build assets and also make more money as a result. And so by creating a Roth IRA and having those tax-free withdrawals, you're benefiting yourself by paying less taxes in the future.
Yeah, so I know a lot of you already have a brokerage account open, but let's look a little bit about what is a brokerage account and who can open it. Essentially, a brokerage account is just a platform that helps you buy and sell securities, whether it's stocks and bonds or crypto, whatever securities you're interested in. A brokerage account will help facilitate that. These will also offer financial advice and market analysis tools. I personally use Charles Schwab. One of the main reasons I love Schwab is because they offer great market analysis tools and analyst ratings. So with every stock, I'll go in a little more detail in the next slide, they'll give an analyst rating. So say I'm interested in buying Apple. A bunch of analysts will compile their reviews and recommendations and give a detailed report as to what's Apple's valuation, what's their profitability, how are they growing. The analysts will do all that work for you, and that's why I like Schwab a lot versus other platforms. So who can open a brokerage account? I don't know if there are any international students here, but I believe you need a social security number or an ITIN. I'm not really familiar with what an ITIN is. Maybe the internationals are more than me, but you need one of those two forms of identification to open a brokerage account. One thing to keep in mind with brokerage accounts is that some of them have annual fees, some of them have monthly service fees, and a lot of them have zero fees. So when you're looking for a brokerage account, you want to look for those that have zero fees. So let's look at a little more specifics. So how do you choose a brokerage account? When you do a quick Google search, you'll probably see a bunch of platforms. You'll see Charles Schwab, Fidelity, Vanguard, JP Morgan, Robinhood, Webull, whatever. There are tons of different brokerage accounts. What are the pros and cons to each? How do we choose one specific one? The first thing to consider is, what are your goals? Are your goals investing in bonds, cryptos, options, risky assets, or passive income? Are you looking for a long-term investing strategy or something like day trading? So figuring out what are your own individual goals. I'm a long-term investor. I like Charles Schwab for that. Another thing to consider is fractional shares. So not everyone can afford to buy the full share for each share that they're investing. So let me give you an example. I'm not familiar with the exact price of VOO. VOO is an ETF that tracks the returns of the S&P 500. I think it's somewhere in the range of $400 to $500. So if you want to invest in VOO, which is an ETF that tracks the market, you would have to invest $400 or $500 at once. Not everyone has $400 or $500 that they can invest at once. So some platforms offer a system where you can get fractional shares. So maybe I only want to invest in 5% of one share. You could do that on some platforms. I know Charles Schwab does not have fractional shares on ETFs. It has fractional shares on stocks in the S&P 500, but no fractional shares on ETFs. So if I want to buy one VOO ETF, I would have to put $400 or $500. Fidelity, on the other hand, it has fractional shares on ETFs and all stocks. So I think that's one benefit of Fidelity that isn't there in Charles Schwab for retail investors. The next thing to consider, like I mentioned before, is the fee structures. Most of the brokerage accounts now have 0 fees, 0 commission. In the past, they all used to charge commission. Now they all switched to its 0 commission, 0 fees. Some of them will have fees, however, so you want to keep an eye out for that. And then account minimums. Obviously, we're all college students. People invest different amounts. Some brokerage accounts will have an account minimum, say $25,000. Not everyone has $25,000 to invest, so you probably want to look for an account that doesn't have that account minimum. And then finally, something that I find very valuable are the resources. Are there educational materials? When I search Charles Schwab on the internet, maybe when I was doing this research for longing or shorting stocks, Charles Schwab posts videos of educational material online, and you can access that for free. What does the customer service look like? If I'm ever having an issue or difficulty with executing a trade, can I contact someone immediately, or do I have to go on hold for 2 hours to figure something out? And then finally, like I mentioned before, the analyst ratings. So most platforms give an analyst rating, but some platforms give more in-depth analyst ratings. So I know when I used to use Robinhood way back, they would give like an analyst rating, buy, sell, hold, but it would just be a percentage, saying like 70% of analysts recommend you should buy it. It doesn't tell you why, at least if I'm not mistaken. On Charles Schwab, they give a full report as to why the analysts say you should buy, sell, hold, strong buy, strong sell, whatever. They give a full report of the stock, and I find that very, very valuable. Analysts obviously know a lot more than us, so we can use that report as a little bit of guidance. Then when you look at the actual app, this is my Charles Schwab, for example. When you look at a specific stock, so let's take NVIDIA. There are so many different things going on here. You see the name of the stock, share price, the action, whether you want to buy or sell, quantity, order type, and time. Most of these are pretty straightforward, but the order type is something I want you to look at. So when you look at the order type, there's market order, limit order, stop, stop limit, trailing stop, and market on close. We're going to focus in on market, limit, and stop orders. So a market order is an order to buy or sell a stock at the market's best available price. So let's go back to NVIDIA, for example. I think NVIDIA is trading around $135 or $136 a share. Say I want to get into NVIDIA stock. I want to get in right now. I'm not really concerned about buying NVIDIA at 130 or buying 140. I just want to get in the stock right now. So I'm going to place a market order to buy NVIDIA, and I'll probably get it around the current share price it's trading at. So it ensures an execution, but doesn't guarantee a specific price. So if I'm looking to get an NVIDIA at $130, and it's currently $136 a share, maybe a market order is not the best for me. But if I just want to get in the stock right now, in the next 15 seconds, a market order is the way to go. These are typically placed when the market is already open. That's because you want to place right away. If I place a market order at 6 p.m. when the market is closed, I don't know what's going to happen to the stock from 6 p.m. to 8:30 a.m. the next day. Maybe I'm thinking I'm buying the share at $136, but maybe the next day NVIDIA jumps to $145 because of some news overnight that I'm not aware of. So then I'm spending a lot more than what I originally anticipated. So a market order is generally placed when the market is already open. If you don't know when the market's open, it's 8:30 to 3 in Central Time, Eastern Time, 9:30 to 4. So just keep an eye out for that. The next is limit orders. Wait, is 8:33? Yeah, 8:33. Okay. The next is limit orders. So these are orders to buy or sell a stock with a restriction on the maximum price to be paid or the minimum price to be received. So, like I said with the original example, I want to buy NVIDIA stock, but maybe I want to wait till the share price falls to $130. Say, I think maybe it's a little overvalued, I'll wait a little for NVIDIA to fall a little. So, I want to buy NVIDIA when it's $130. So I'll place a limit order saying, right when NVIDIA stock falls to $130, this order will be executed and it'll buy NVIDIA stock. The problem is, there's no assurance of execution. What if NVIDIA stock never falls to $130? That order will never be placed. This is active for 180 days, but in the event that it doesn't happen in the 180 days, your limit order will expire. So this could be a good strategy if you want to wait a little for that moment when NVIDIA's share price falls up to $130. But if it's just a matter for a few cents, maybe you don't want to risk not getting in the position, right? Let's say NVIDIA's trading at $136. I place a limit order for $135.90. What if it never goes to that and it actually jumps to $150? I missed a big opportunity for 10 cents. Is it worth it? I don't really know. The final order type is stop orders. So there's two types of this: buy stop orders and stop loss orders. I know Jonathan Chang loves his stop losses, but essentially a stop loss helps protect an unrealized gain or to seek to minimize a loss. So say NVIDIA is at $136 a share, and just in case NVIDIA falls, I wanted to sell it at $120 a share. So I'd say NVIDIA is rapidly falling. The trade is going to execute at $120 a share and sell it. So just in case NVIDIA falls to $80, it will be sold at $120. See, I'm not monitoring my portfolio every day. I'm not checking it like that. I don't want NVIDIA's share to fall so much without me realizing, so I'd set a stop loss order just in case that share price falls. It'll sell at the target price. Buy stop is a similar way. Maybe I'm not checking my portfolio actively, but if NVIDIA is gaining, I want to get in on it. So maybe NVIDIA is going up to $140. I'll set a buy stop saying, when NVIDIA is growing, my order will execute. So it'll help me profit from upward movement in stock's price by placing an order in advance. So I don't want to get too far behind, so I'll place this buy stop so the order will be placed. Stop loss is more common because you're trying to minimize a loss, but people will still use buy stop orders as well.
And another thing to note when you're placing an order is your position on the stock. So when investing, there's two typical terms. You're long on a position or you're short on a position. Now, if you're long on a position, that means you typically view the stock with a bullish attitude, meaning that you think the stock is going to go up in price. And to be long in the position, you have to own the stock. So that means you purchased a share of the stock and you're holding it, hoping for the price to go up, and then you can sell the stock back and gain whatever profits you made. Now these are typically more long-term, as the name suggests, because stocks usually take a decent amount of time to grow, and it's hard for companies to have this explosive growth overnight, even though that does happen. Now the opposite of that is a short. Essentially what a short is when you think a stock is going to go down in price, you would short the stock. Now what does that mean exactly? Well, when you short a stock, you are borrowing a share of the stock from your broker, and then you sell it to someone else. And then when the stock price drops, say a few dollars or $10, then you buy the stock at the lower price, and then you do what's called covering your loan. So at first you loan the stock from somebody, and then gave it away, and now you're repaying that loan but at a lower cost. So then you take the profit that is the difference between where you loaned it and where you finally bought it at.
So I'll summarize this in two quick words. Buying means you want the stock to go up. Shorting means you want the stock to go down. There are a few things to consider with this. When you long a stock, theoretically, your returns could be infinite. Apple could theoretically go up infinite amount percentage. My losses are capped. Apple can only go to $0, so I can only lose the amount of money I put in. When you short a stock, my profits are capped because the stock price is falling. So when it goes from $5 to $0, that's the maximum of returns I can get. However, my losses theoretically could be infinite because that $5 could go up infinitely. So there's much more risk with shorting than there is to longing. Now there's another factor to consider. Markets historically always go up. Stocks tend to follow that pattern for the most part. So when you look at large cap stocks like Apple, it's likely going to follow the returns of the market. So when you short a stock, you want to be very confident, like this is a terrible company, it's probably going to go down in the future, like Beyond Meat. Who's eating these vegetarian patties or whatever they are? This is one of the most common shorted stocks, and it's been doing horrible as well. So.
And now let's look at what funds are. Now, when you're investing, you can invest in individual stocks, bonds, or a combination of both, which is usually seen in funds. So the first one we have is index funds. I'm sure you've heard of the term index funds, as it's pretty popular for people to say. One of the most popular index funds is the S&P 500, which just tracks some of the market's top 500 performing stocks. And an index fund, like it says, is a tracker. It'll follow the price of a certain market, and it's usually good to diversify your portfolio and be relatively safe because you're investing in the whole market. Mutual fund, on the other hand, is essentially a bundle of investors. So people will give their money to a mutual fund, and the mutual fund owners are professionals, and they will manage your money and actively trade your money in their own portfolio. Now, one example of this is the Magellan Fund, which is run by Fidelity, and they are licensed professionals that take your money and try to invest it for you and beat the returns of the market. Now, last but not least, we have exchange-traded funds, also known as ETFs. Now, ETFs are also very popular right now because what they are is a bundle of investment securities, and you can invest in these like it's an individual stock. So when you're investing in an ETF, you're investing in things like stocks, bonds, even crypto now, and so you're able to be exposed to a lot more than just the individual stock price.
Yeah, so index funds are passively managed. I'm going to invest in a basket of stocks that's going to stay the same over a period of time. Mutual funds are actively managed. This portfolio will be actively changed because of these investors. So mutual funds tend to come with higher fees than index funds do. Index funds generally have fees, but very, very low percentage, whereas mutual funds tend to have a higher percentage of fees because those investors are trying to beat the returns of the index funds or of the market. So now that we looked at how to open a brokerage account, what are the factors to consider, what are the different funds, longing, shorting positions, what's our strategy? I want you all to point to this statistic. 94% of active fund managers don't beat the returns of the market. You've probably heard me say this a couple times throughout the semester. If 94% of active fund managers don't beat the returns of the market, what makes you think you're one of the 6% that will? What makes us think that we're one of the 6% that will? So index funds are the safe, passive investment strategy that lead to good returns over time. I'm not recommending you to do it. You can do whatever you want to do. But index funds historically lead to positive returns, very safe, not time-consuming at all. So now, how do we invest these index funds? Do we just dump it all on January 1st, 2025, and just forget about it? Do we invest it over time? The main strategy that's historically proven to be successful over time is dollar cost averaging. I don't know who's familiar with dollar cost averaging, but essentially it's a strategy where you invest a fixed dollar amount on a regular basis regardless of the share price. So let's look at this example. Pretend we have this stock that's $10 a share. We have two different scenarios. The top scenario is someone who just invested $8,000 on January 1st and waited till August. No money put in between. The bottom scenario is someone who invested $1,000 January, $1,000 February, $1,000 March for an 8-month period. Over time, from January to August, the share price didn't change. in the months leading up to it, it did change, however. So in the first scenario, the investor had a 0% return because it was $10 a share in January, $10 a share in August. In the second scenario, because the investor was investing $1,000 each month, they actually made a 4% return. So even though the share price didn't change from January to August, it changed in between, the second scenario, dollar cost averaging, made more of a return. So this is a good strategy that gives you exposure to volatility in the market. The markets have been pretty volatile over the past couple months. Had you invested in January, you might have had a different return had you dollar cost averaged it throughout the rest of the year. So dollar cost averaging is a great strategy that gives you exposure to passively investing in these index funds and getting exposure to the market. Now, one thing to consider with dollar cost averaging, like I mentioned before, some brokerage accounts don't allow you to invest fractional shares. So depending on how much you're investing, say an index fund costs $400 to $500, if you plan to invest once a month or once every 2 weeks, maybe you don't have $400 or $500 to invest that frequently. So maybe you want to look at a brokerage account that allows you to invest fractional shares so you can dollar cost average. It's a really big factor. So that pretty much wraps up our Investing 101 Beginner's Guide to Investing. Do any of y'all have any questions?